Hey, welcome to 2022. I'm Justin Bogart. I'm your host for the Real Estate Note Investing Be the Bank broadcast. This is our first one for 2022. And we're going to talk about the Gen Z, how they're optimistic about purchasing a home. We're going to be talking about what's going on with the rate locks. We got some case studies for you for today. And I'm going to bring my old pal Richard Thornton on. We're going to see how his trip was during the holidays. I always like that intro music. How you doing, Richard?
Pretty good. Yeah, it kind of makes you want to get up and dance and
moving
around.
Yeah,
That's right.
So how are you, man?
I'm doing great, thanks. As you mentioned, just got back from a little bit of vacation, which was nice. We were supposed to go to Thailand, but got closed out of there due to COVID, and ended up in the Yucatan Peninsula, which was fun because we got to see how people used to live 3,500 years ago in the Mayan ruins.
So you were going to the land of ties, where
That's
you
right.
see a bunch of bow ties and neckties. Is that?
That's right. All those ties. That's right.
You are fancy like that. All right.
That's right. That's right.
Well, I know you had your heart set on going to Thailand because I know you like visiting there and stuff. But I heard you had a great time, like you mentioned, and it's pretty cool to see all that ancient stuff. Let's see. I went on a trip to Chattanooga, Tennessee, in our camper, which is actually where I'm filming right now today because we had some power outages going on at the office. So I didn't want to take a chance of the power going out in the middle of our broadcast here. So I decided to set up shop in the camper, and where I know I got some good power going.
Well, good. It's too bad you're not wearing an orange shirt today, because if you did with the gray background, it would look like you're in a lineup. So, I got my own shirt on, so you could have yours.
There you go. Okay, well, you're in the lineup then.
That's right. Have this little thing that says Justin Bogart in front of your face, and number 57775. But
all right, for those of you listening to us ramble on here, I'm Justin Bogart. This is my buddy Richard Thornton. We're going to be going through the broadcast today in just a minute. If you have any questions related to real estate note investing, please use the comment section if you're on Facebook or if you're on YouTube, and we will see those comments pop up. If you just want to say hi or hello, or if you want to poke fun at us, we're all game for that as well. Any question you have about real estate note investing, we encourage you to throw it out there, even throughout the presentation for today. We will have a section at the end where we'll actually do a lot more Q&A, where it'll just be no presentation, just be Richard and I answering questions and stuff. Sometimes we do pull up some of your questions during our presentation so we can answer them. Don't forget to subscribe to the Bright Path Notes YouTube channel by smashing that subscribe button. All right, Richard, let's get into what we're talking about today.
All right.
All right, what's happening? Let's see here if I can get my technology to work for me. All right, Richard, so this broadcast will not be sponsored, as you know, without some help. And so our company, Bright Path Notes, we've got the deal flow to make your cash flow. You can see my email, justin@brightpathnotes.com. Looking for note deals? Come send me an email. We'll get you squared away. For those of you that don't know, we have a local real estate investor association group here called CIREA. And the executive director, you can email them if you're interested in being a member. We have about 700 to 800 members right now. They're all Indianapolis-based investors here. Some of are out of state as well. It's a great place to connect if you do have properties here in the Indy area or surrounding Indiana area. There are some boots on the ground here that can help you, or you can offload some stuff as well. We have people that do that. So 317-961-3367, and that is your real estate education sponsor. And our note investing training software that myself, Richard, Larry, and Mariska did, it's called Constant Cash Flow. And if you email info@brightpathnotes.com, we can get you more information. We can send you a link. And for a very, very limited time, Richard, for $97, you can get over 25 videos from
Mhm.
folks like us,
Mhm.
training you, teaching you, educating you about the note basics and the foundations of note investing. You will not find a deal like that better out there, and you will not find this pricing lasting very much longer as well.
You
So for
better get it while it's
$97,
hot. That's right.
you better get it while it's hot. We've got a lot of
It's
good reviews back from people taking our training course, so we're excited for you all to try as well. And last but not least, New View Trust is a self-directed IRA company that is one of our sponsors as well. We encourage you to use them. We've had them on the broadcast as well. And if you mention this broadcast, they're going to waive the setup fee for you. New accounts at newviewira.com is who you would email to set up your IRA account for your 401k, for your IRA, your Roth IRA, your Coverdale Education Savings Account, your health savings account, all those retirement accounts. They can handle it all for you. All right, Richard, this slide is just for our folks that are part of a CYREA membership. We want you to do your PHP credit. So take your smartphone out, pull up the camera, hover over that QR code there. That'll get you to your PHP credits. And that is where you can sign in so you get credit for today. You like those air quotes? I use air quotes a lot. I don't know why. I just do.
Justin, it's interesting. I like the fact that you're bringing up this QR code, but QR codes were actually invented years ago for the auto industry, the Japanese auto industry. But it's just recently that they've taken off. What I mean by that, as I go travel internationally now and everything like that, almost all the restaurants have got QR codes for you to download their menus.
Yeah, that's right.
You want to get any information on any little offering around a town, you just do a QR code. It's pretty amazing.
Michael says hello, Richard.
Hi, Michael.
Michael is one of our listeners or viewers that is on regularly. So thanks for joining us again.
Mm-hmm.
All right, let me get back to what we're going for here, Richard.
Okay.
Guess what?
What?
I rebranded my podcast again.
Oh my God.
The podcast is called Be the Bank, and it was formerly called Two Wealth Show. My co-host Super E has decided to sign off, and she hung up her reins. She said she had a good run. She really enjoyed doing the podcast, but she is having some major positive, great growing experiences within her company, and she needs to really focus on it. So she doesn't have a lot more time to dedicate towards this podcast. So I'm going out on my own. So I rebranded the podcast called Be the Bank. We're on our 4th season, and the very first episode, Richard, dropped today. And we interviewed Mr. Mick Kuhn, who I know you know very well. And he has a book out called, jump off screen there. It's called The Property Preservation for Note Owners is what's called. You can go to Amazon.com and you can order that book. It's a very short read. It's probably, Richard, I don't know if you've read this or not, but it's less than 50 pages, but it has a ton of great content in here. I have used this book personally. I've referenced it several times the past couple of months because we've had a couple of properties we had to take back for REO. This tells you stories that he's been through. He's an REO agent. He's experienced a ton of weird stuff that goes on. It tells you exactly what you need to do. If your borrower stops paying, if your borrower vacates, if your borrower's there and stops paying, like he goes through all these scenarios and he tells you all these things that you need to be aware of and what you want to check on and what you want to do. Highly encourage you to get this. This is the Property Preservation for Note Owners. Download that book.
Plus, Mick's a really good guy and he's a font of information. So I'm sure if you emailed him, he would be glad to help you out.
Yeah, we had him on the podcast. Like I said, if you listen to the podcast, we bring that up in there as well. So we highly encourage you to do that. So our podcast is on all the podcast directories, and you can watch the video of it on the Bright Path Notes YouTube channel, and it's posted as of today. Richard, let's get into some data. So we used to bring up the Mortgage Monitor update because it would basically, the reports would come out the day of we're filming this or the day before that we're filming this.
Right.
It didn't come out just yet, but what they did come out with was the mortgage originations report now. And so now we look at numbers from a different perspective because we've all heard about the forbearances. We've heard about real estate appreciating. We've heard about interest rates being lower. And this was this is kind of an interesting snapshot based on the month of December only. This is for the mortgages that they capture through the Black Knight financial data. And you notice the rate lock volume is down. So historically, Richard, I think you agree with me, people aren't really refining in the winter months. It's just historically, it's just things are not moving as much. They're not buying and selling as much in the winter months.
Yeah, things pretty shut down pretty much after Thanksgiving. Basically, they don't want to. They got other things to look at.
Yeah. So you guys can read into it, but I wanted to point out something, Richard, to you, and I don't know if you caught this just yet, but the average credit score for refis are 20 points lower than they were this time last year.
Right.
Okay? So this has to do with the higher credit borrowers, meaning people with the higher credit scores. They tend to stay out of the rising rates and trying to refi because they know they can get the lower rate because they have the better credit score. So that's the reason why that has dropped. So from 729. So if you do the math, it was 749 this time last year, which is amazing how you have to have such a great credit score.
Yeah, which makes the private mortgage market all the more viable. And
it does.
Something I think it's worth. I mean, you're to your point, where the better credit score people are taking advantage of the market. The market's moved up 30 or 40 bips over the last 2 months. It's still great.
Explain bips.
Basis points. So you've got for 1 percentage point, you have 1% of 1 basis point, and so that is called in the jargon that's called a BIP. The abbreviation is BPST, I think, BIPs.
Okay, so a 1% interest rate increase is 100 bips.
Right.
Okay, that's how the math works. All right.
Right. So markets moved 30 bips up over the last 2 months. So a lot of people were diving in. My indicators out here anyway said that as of 30, 45 days ago, you could get a 30-year fixed mortgage for 2.95%. That's amazing. It's moved up, but not much.
Yep.
It's still very good. But I think that this lower rate lock number is indicative of that.
Yeah. So the rates are creeping up a little bit. They don't seem like it's moving too much. I think the lowest, like you said, Richard, maybe it was last year. I think I heard it was 2.4, 2.5. Right. Some even said 1.9, but maybe that's for 15-year. But we're talking about 30-year locks.
We're talking about 30-year. And you probably caught the news. Fed Chairman Powell said today that things are getting pretty hot and looks like he's going to move rates up. So I would imagine that our rate lock volume is going to increase here next month because people are going to start jumping in to get the deals done.
Yeah, especially if they haven't done it already. You're exactly right. They're going to get in there and get some refis done. Mm-hmm. Okay, Richard. So the top 20 markets for locking up these rates. These are the top 20 markets. So everything is a negative as far as the month-over-month growth because we're obviously not seeing as much refi as we were from the month before because of what we just explained. Mm-hmm. But look who is looking pretty good out there. San Fran, baby. San Fran. All right, so Richard, we have a complete disparity between the Indianapolis market and the San Francisco market. So the average loan amount there in your San Francisco market is $725 for a loan amount, which happens to be 62% of LTV.
Right.
So it looks like things are easily over $1 million for loans out there for properties, let's just say, in the San Fran, Oakland, Hayward area.
Yeah, I mean, it's good news, bad news. I think the median in the general San Francisco Peninsula area is now 1.3 or 1.4 million.
That's incredible.
And that has gone up 20% over the last 12 months.
Purchase versus refi. Look at that percentage. So as you can see, some of those purchases are higher. I'm getting a little bit of echo, Richard. Some of those purchases are a little bit higher in percentage versus some of the refis are a little bit lower or higher. So to me, that's indicative of the local market there being appreciating a lot more in value, and maybe the interest rates are more appetizing for somebody out there. So it looks like to me that people are doing cash out refis on the San Francisco market, because 60% of them are refis.
Yeah, I think that's probably accurate. Also, I don't know if you caught the DS News or if you wanted to talk about this later, but if you look at the CoreLogic data, they're saying that a lot of the non-performing loans and this huge tsunami that we thought was going to come at us isn't. It basically has fizzled up thus far, because a lot of people are refinancing out of their forbearance. If they had 6 or 8 months of forbearance, the banks are saying, yes, we understand. And oh, by the way, you've got a ton of equity in your house. And oh, by the way, you can drop your interest rate by a 4%. So guess what? Ta-da! Which is, unlike any recession or anything like that we've ever had before.
Yeah, it's just amazing. I can't fathom living in my market versus living in your market. It's just so odd to see that. So,
right.
But hey, Jim, he says hello.
That's right.
Thanks for chopping on today. If anybody has any questions about real estate note investing, please go ahead and throw them in the comment box. We will have some case studies at the end today. We're just kind of get through some stories and some things that Richard and I just kind of want to point out to you all. So use the comments. All right, Richard, let's go to the next one here. So this one, Richard, I'm going to let you explain this a little bit better because you're the BIPs guy, since you explained the BIPs earlier. So what this is for the listening, viewing audience here is 10-year Treasury line is in blue, and the 10-year, the 30-year conforming line is in, I guess, is it orange on your screen? Mine
it's
orange. Discolored a little bit.
Right.
So the current value as of today is 3.35% for the 30-year conforming loan, and the current value of the Treasury yield is 1.52%. So the big filled in section of the graph is the spread between those two. And it's important to look at the spread because I'm not an economist, first of all. This is just what I've read and what I've kind of been educated on just reading myself, is that, and Richard, I want you to jump in here and help explain. It appears that if the spread is larger, that may be a riskier market in general for our country, as far as investing in the economy.
Yeah, well, so typically, obviously, your 30 rate money is going to be more expensive than 10 rate money, right? Because you've got more rate risk, and that's what people don't want to take is rate risk. And the spread is completely based on the expectation of whether rates are going to go up or not. So the fact that you've got a fairly even spread here indicates that for all of last year anyway, people really didn't think rates were going to go up very much, because if they had, you would have seen the 30-year start to creep up more than the 10-year.
Yeah, right. So this gives us an indicator as to how the future is going to look like. So I did see the comment you made about the Feds raising. Yeah, I think they are going to make a couple of raises this year. We don't know how dramatic it's going to be. Usually, Richard, what is it? A couple 100 basis points maybe throughout the year. Maybe I'm sorry, not 100. I'm sorry. It may be not maybe a full percent, but maybe start creeping to a full percent increase over the year.
Yeah, they usually increase a quarter to a half, and just depending on how drastic they feel they need to be. I mean, the economy is experiencing inflation. A lot of it is due to the fact that it's just supply chain. I think a lot of people are saying, gee, if it's supply chain, then that's going to be fairly temporary. So it's not affecting spreads so much yet. If this goes on into the third and fourth and fifth quarter, then we'll start to see maybe more permanent increases. But right now, people don't really know where the market's going to go. So it's not hitting us too much yet.
So it's no man's land.
Exactly.
We could teeter, we could totter.
Mm-hmm.
All right. This is from DS News, Richard. So the Homeowner Assistance Fund sounds familiar, right?
Right.
The Treasury Department will provide financial assistance in an aggregate amount of approximately $9.9 billion. The $9.9 billion will be distributed to the states and run at state level. Some states are using the funds that they have received to run pilot programs. As of today, approximately 18 states have pilot programs up and running. So let's take a look at the map that they provided to see what states are there. So this is important for if you are in the note field and you have a non-performing loan or a loan that's becoming delinquent. These are programs you want to be aware of and listen to in your area. So in my screen, it looks kind of pink, maybe light violet. Those are the states that currently have the pilot program running. And the ones that are, and help me, Richard, I can't tell what color it says, maybe a darker blue, almost green. It looks like those are the programs that are accepting applications statewide.
Right. That's a darker blue. And one thing I would caution people on, listeners on, is that this is for conventional mortgages. So if you have a private note, it may not apply.
Correct.
So you have to call your state program and find out.
Correct. So there is a website. I'm going to throw up some stuff in the chat box here, Richard. If you want to talk about maybe the homeowners assistance fund from the past experience of the of when non-performing loans were a lot more plentiful.
Yeah. So
I'm gonna throw some stuff in the chat for you guys to.
The older name for this was hardest hit funds. And a lot of states did distribute a lot of money and really helped a lot of people. It's great for us as investors and did apply to a lot of people who had private mortgage notes. The way it was fantastic for us is, let's say you had a $50,000 note and you had had $50,000 outstanding, but you had only paid, let's say, $30,000 for that note. Well, the federal government may have been willing to give you give your borrower $25,000 as a bailout. Well, that $25,000 goes to you. You're still owed $50,000, or the remainder of you're still owed $25,000 if you had a $50,000 note, and you've only got $10,000 in it. That's a fantastic return.
It is. And so people became pretty wealthy overnight in some of those situations.
Right.
So right now, I'm also putting in the chat the link to the Homeowner Assistance Fund website.
Okay.
And so that's where I got this information from earlier today. So if you're on Facebook or YouTube, check that link out as well. So save it to your browser, and that could be a good thing for you to know in the future to help you out.
Right.
So, all right, Richard, let's get back to today's entertainment. If I can. Come on. There we go. So did I skip one? No, I'm good. All right. This article was kind of fun. I had to share it because it's just funny to me. So Gen Z, Richard, do you know what Gen Z, or who qualifies to be Gen Z? If you know, and you're listening right now or watching us, you know what the Gen Z qualification is as far as what year you've been born, please chime in the chat box for us, in the comment box. But Richard, what do you think it is?
It's people 5 years old and less, right?
Zoomers, Gen Z, Zoomers. Yeah. I don't know for sure. I did know that information. I know, the millennials, the Gen X, and, the different generations. I did know those at one time, but I get so confused now. I don't know. There's Gen Wi-Fi.
Yeah. And by the way, you mentioned Wi-Fi. If you go to Cuba or the south of Mexico or Guatemala, you don't have Wi-Fi, you have Wi-Fi. So you have to ask everybody if they have Wi-Fi. That's right.
Wi-Fi? I call it Wi-Fi sometimes. People are like, what are you talking about? Wi-Fi?
That's right.
Oh, Wi-Fi, you dummy.
Yeah, I mean, I'm a boomer. What are you?
I believe I'm Gen X.
Okay. All right.
I am currently 43 years old, so we're 1978. So do the math. I think I'm Gen X. I don't know. Somebody's out there that's listening right now has got to know the answer for us. Please chime in the comments box for us. Anyways, so about 3 years ago, this they recorded some data on Gen Z because basically they were a little skittish about home ownership. Now, a little more optimistic about home ownership. But 29% of those Gen Zs have purchased a home, okay, in the last 3 years. 38% still live with mommy and daddy.
Right.
That
So,
was interesting.
hot off the presses,
Yep.
Gen X was born in 65 and went to 1980.
I'm in Gen X.
Millennials went from 81 to 96.
Okay.
Okay. And Z went from 97 to 2012.
Thank the person that brought that up.
Mm-hmm.
Who brought that up to us?
James Sincox.
Jim from Chicago.
That's right.
Thank you
There we
very
go.
much.
That's right.
Thank you very much. It's good to see you back on YouTube, my friend.
And so what do we have? So if you're born after 2012, what are you?
You're only 10 years old.
You
You don't get data. You're not recording any data yet.
It'd be called something, but all right.
Look at this. 1 in 3 Zoomers live with their parents. 1 in 10 millennials live with their parents.
All right.
That's interesting. My camera's blocking some of the stuff, Richard. So help me digest this data here. So we're looking at who's renting more.
Okay, so the renters, most renters are Gen Zers, followed by millennials. Gen Zers are 33%. 24% of the millennials are renters, but they're actually the overall rent rate is still 23%. So that's pretty high, and actually speaks well for the rental market, and also why multifamily investments are probably doing pretty well.
Okay. So that could be your tenant that may not have enough credit scratch to go out and get a bank loan.
Right.
So
the Zers also 29% of them are homeowners, which is way behind the Gen Xers, which makes sense because the Xers have got more cash flow because they're older,
more seasoned.
Mm-hmm.
All right, so 38% living with parents of Zers, 12% are millennials, 5% are people like me, Gen X.
Mm-hmm.
Okay. And a homeowner, 78% Gen X, 64% millennials, 29% Gen Z. Okay. So we're just looking at the demographics here so you can kind of see who needs help with private financing, right?
So it's interesting. I wonder why they left boomers off their chart.
They expect them to be probably in retirement.
Mm-hmm. So they don't need to live anywhere?
No, they do. I just think the data might be skewed. Well, I mean, if you think about it, you yourself, you're retired, but you're still working.
Mm-hmm.
And if you're in the baby boomer class, there's probably a lot of baby boomers in your that age. How Jim put that up there, whatever age group it falls into, that are probably just in Florida, maybe in a I don't want to say assisted living. I want to say like a community.
Independent.
Like an independent community where they don't need assistance, but they just live somewhere where they're kind of renting. So I think the data will be skewed for baby boomers.
Could be.
Just my thought.
Yeah.
Who's happiest? Gen X is happiest with their homes. Millennials remain most dissatisfied. I think they're always dissatisfied, Richard.
Yeah. How do you qualify satisfied?
I don't know. I just thought this data was interesting and I threw it out there. This is an article from is it Housing Wire that we got this from? I think it was Housing Wire, maybe.
Could be.
Or DS News. I don't remember. One of the two. Anyways, this was interesting data. So thanks, Jim, for your help with breaking us down there on it. Richard, read that for me. It's kind of too small.
It says, overall, home sharing is most popular among adult Gen Zers, with nearly 1/4 of respondents currently living with friends or roommates, compared to only 7% of millennials and 5% of Gen X, who reside in a similar setup. Gen Z respondents are also the most likely to live in an intergenerational household, with 14% sharing their home with 2 or more other generations. That's similar to 11% of Gen Xers who are living in the same type of household.
Interesting. So intergenerational household. So it
Mhm.
looks like they're combining incomes, or just families are blending together, as far as not blending different families, but the family is 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 living in the same house. That's interesting.
Yeah, actually, you know what? It
Makes
makes
sense.
sense because
Hmm.
it's going back to the old way, which was, um, in a lot of instances back in the day, maybe in the 40s in the U.S., and it's still prevalent in a lot of foreign countries. Um, the uh, Younger folks didn't have enough money to go out and buy a house, so
Yeah.
they'd live with um, mom and dad, either the bride's or the groom's mom or dad,
Yep.
and grandma and grandpa may have been there. And we've seen a lot of that um, traveling around foreign countries. Um,
Oh, I bet.
yeah.
I bet. Thanks, Lisa, for your comment. All right, Richard. Fannie Mae, 15
Mhm.
billion in CRT deals in 2022. I thought I remembered what the CRT meant, the abbreviation. Richard, do you happen to remember what it is?
I think it's credit review transaction or something like that.
Yeah, it is something like that. Okay. So Fannie Mae, if you didn't know, it's one of the biggest mortgage buyers out there. When a Chase Bank or a Bank of America or Wells Fargo creates a loan, Fannie Mae and Freddie Mac and Ginnie Mae and all these government enterprises will swallow up those loans at the closing table, and they'll hold them in their portfolio with their investors. Then they divest themselves of it. They're divesting themselves of probably more of this stuff that is in forbearance, and it's just on their books, and it's putting them in the red. And so Richard and I, we didn't get a chance to read the whole article because you had to pay to read the whole article. So we're just making some assumptions here that the 15 billion is probably just going to be the first wave of delinquent loans that they're going to be selling. I believe, Richard, if I remember the article correctly, I think it was leading us to believe there's about 50 billion in unpaid balances that are going to be released throughout the year from their set of loans, which comes out the 15 billion comes out to about, Richard, I believe 1.7 trillion
Right.
in property value.
Yeah. So for anybody who doesn't know it, I mean, you hear Fannie Mae and Freddie Mac bounced around a lot.
Yeah.
And what you may or may not understand is, why do they exist? Well, they are the secondary market. Why do you need a secondary market? A bank can make a loan, uh, but banks make loans and what's called non-bank lenders, which are private companies. They have to turn their portfolio because they make money on the servicing fees and the upfront origination fees. So the reason we have a Fannie Mae and Freddie Mac is so that they can take those in bulk, they can package them up, and they sell what's called a REMIC. And a REMIC has different tranches on it based
Mm-hmm.
on um, the risk associated with the loans. They bought a bunch of overly aggressive paper when it was before the recession, and that's partly what led us to the recession. And they don't do that anymore. But and then so when they sell that paper, they're selling it to a lot of pension funds, insurance companies, groups like that that need really safe investments for their pensioners and their
Yeah.
clients. So that's how the market works.
The great explanation. Thanks, Richard. All right. I got some case studies to talk about here. So I did something that not a lot of people do, Richard, but hopefully people are going to start doing this. And so my case study is based on, I happen to have a motivated seller that I found through, direct mail and things like that and connections. And so this motivated seller had two properties that were pretty close to each other on the same street, and they were wanting to sell the land contracts on them. So I said, hey, I looked at the deal. I saw the pay history. I saw the property value. I saw the documentation. I saw how long they were paying and all those things that you and I go through to value a loan. I said, you know what? I'll buy these from you, but I want you to convert them to a note and mortgage.
Did you discount the contracts more because of the pink door?
No, I actually didn't know about the pink door until I did some more research on the BPO. I think it was more recent that the pink door was like that. But it's a cute house. Both of them are nice houses.
I mean, that's something you'd see in San Francisco, the pink door. But
this happens to be in the Indianapolis area as well.
Okay.
This one's worth about $95K. This one's worth about $70K. All right. So they're both land contracts. They both on the same street. The owners of the properties happen to be relatives of each other as well. So land contract conversion. So I'm gonna walk through this, Richard, and I'm gonna kind of explain the reasoning why I'm doing this. So my stipulation before I purchase them is that you must convert them to a note and mortgage before I buy them. So what do? You got to go through a title company. You get a loan policy. You escrow the taxes and insurance and make that a part of the deal. You board it with a professional loan servicer, and you set up ACH payments. So I did all this in one fell swoop and had them set this up through a title and through a closing. At the same time, Richard, I also bought the note and mortgage on the same day at the same time in the same transaction via an allonge and an assignment of mortgage.
Okay.
So we canceled a land contract. We created a note and mortgage. We transferred a deed. We got owner's title policy. We got lender's title policy. We got new insurance. We escrowed everything. We got the loan boarding process set up and got them on ACH payments all at the same time, the same day.
Mm-hmm.
It's a lot of work.
A lot of work.
A lot of coordination. Borrower's got to be involved. Seller of the note's got to be involved. And then I am trying to lead everyone down to the finish line here.
Mm-hmm.
What happens now is I have a highly marketable loan for sale. The borrowers are now on the deed, so these are positives for them. The seller, I didn't mention this in the write-up there, but the seller obviously got paid out what they wanted to get paid out. I've now got the borrowers paying on ACH instead of just writing a check and mailing it, because now they have the capability of paying it how they want through an online process. And there's a full escrow already built into it, and someone is analyzing this with taxes and insurance. That's why I did it, Richard.
Good.
For the first one, highly marketable loan. I'm in the business to sell loans, Richard.
That's right. So now you can take advantage and get better pricing since you have something that's lower risk and more commoditized, right?
Exactly. I did more work, and I took on that risk knowing that I could have a higher valued commodity to sell. Exactly. Mm-hmm. All right. So the first note in the order of the picture that it was, the left one and the right one, that one was about $33,000 balance, 7% interest rate. It has about a $600 a month payment. There are only 67 months left. That's just a little bit over 5.5 years. And I actually sold this asset pretty quickly, actually, right as I boarded it. Just so happened to be I had somebody eager to buy it. So we already sold it. So I already had done all that work in converting it, going through the proper process, recording all my documents, and then boom, before I even got my first payment, it's already sold.
Mm-hmm.
Second one, we similar situation. The UPB is different because the housing price is different. Same interest rate, 7%. The P&I is going to be 445, and the term left is the same too. Like I said, they're identical as far as they're relatives to each other, and they're on the same street. And so it just worked out when these were created by the original seller that they were written very similar in that fashion. So this one is not sold yet, but it is for sale for $23,084. So that's kind of what we do, Richard, with those. So we bought them for a, what do you call them? A dented price.
Right.
The cans were dented.
Right.
So could I have bought the land contracts, Richard, as is? Of course I could have done that, right?
Sure.
But what I did was I bottlenecked myself to where if I bought them and then I wanted to convert it later, well, then there's some closing costs in there that I would have to pay 100% of, right?
Right.
There are some processes in there that I would have to go through if I wanted to amend the language of the land contract, and if there was something that I didn't like. It was just easier and cleaner to do everything in one fell swoop. I wouldn't say easier. It got kind of clunky, but in doing this, Richard, you see how much value that you add to the borrower. you see how much value you add as a lender, and then the situation where you want to offload this, if I want to, I don't have to. I've got a highly marketable loan, and then I'm able to recoup some money.
Right. So what was the borrower's incentive in wanting to do this?
Well, the borrowers typically don't understand why they would want to do that, because they haven't familiarized themselves with really knowing why you would want a promissory note and mortgage on your house as opposed to a land contract.
Right.
So once you explain to them that, look, if you keep this land contract, yes, it's your house. You gain equitable title every time you make a payment. But you're not on the deed.
Right.
So you're not getting tax notifications. You're not looked at as the deeded owner of the house. Yes, a land contract is a fully enforceable security agreement, but these are just the annoying things about the land contract. I don't want to get the tax notices, Richard. I don't want to get any nuisance liens or violations sent to me or being contacted by the county. I don't want that.
Right.
I want to be the note and mortgage on it, and I want to be the lender on it, and I want to be the bank, and I want to have the first lien on it, and I don't want to have anything to do with the property. I just want to collect the debt on the property. So now, Richard, this loan is going to be a lot easier for them to refinance in the future as well, because now they have a promissory note and mortgage. It's boarded with a licensed professional loan servicer. They got full escrow on it. They're making pay history with ACH payments. Like, these are all good things that's going to help build their credit, because we got their Social Security. Well, we didn't. The servicer got the Social Security number, so now they're going to report the interest that they pay every year. So all these things are good for them.
Right. And when they do go to refi, I've actually had several of my borrowers call me up and say, I'd like to refinance, but the bank says I don't own the property and therefore I can't refinance it. And my response is, you're right. You don't own the property. It makes it very difficult in a lot of instances to explain that to a bank, to get them to know what a land contract is. So this is just much cleaner.
Exactly. Yeah. Try to explain a land contract to someone that doesn't do land contracts is like talking a different language.
Right.
And a subset of that language, right?
Right.
So send us your deals. Send us your deals. We love QR codes, Richard. Pull out that smartphone, put your camera out there, hover it over that QR code, watch that URL pop up. That's where you can send us your deals. We're looking to buy deals. Richard and I both buy deals. We look at them together. We partner together on them as well. We're looking for first liens. If you got land contracts, contracts for deeds, note and mortgages, note and deeds of trust, lease options, we'll buy them. We will buy them. We might even lend money. We've been trying to lend money to people.
That's
as
true.
well.
I'm going to lending money QR to people. Code thing right now. Let's see.
You hovering over it to see what happens? Are you going to sell me one of your loans?
I'm going to hover.
Okay.
It's loading. All right.
Loading,
I like
working?
It. Note quote submission sheet. Dude, you got this set up. Wow, you know how to do this. This is great.
Yeah. It's going to ping you in the middle of the night, so then you have to wake up and do all the underwriting.
All right. Got it.
Lisa had a quick question about the case study I had, so I'm going to pop that up real quick while it's fresh. I said in the property sold for $31K, how much did you invest in earning profit? That's a good question. Off the top of my head, I'm trying to think of those numbers. I want to say that the property I got under contract, the loan I got under contract for, I think, around $26,000, $27,000. I did have to go to closing and pay for some of the loan costs, but I had to pay for all of them. So it's probably out of pocket another, let's call it $750 to $1,000, because I drafted the note and mortgage and the assignment and the allonge and had recording fees and things like that. So I think all in all, it's probably about $28,000 to $27,000 into it. And so I probably walked away with about $3,000 to $3,500 in my pocket in less than 30 days.
Mm-hmm.
So the return on that is pretty outstanding.
Mm-hmm.
So hopefully that answers your question, Lisa. And thank you for asking the question. And please keep bringing questions here, because we love to answer questions. Richard, this is your time to shine. So I want you to talk about the little hypothetical case study that you have. We don't really have to put the numbers up there, but I want you to walk through something that you've run into recently.
Yeah, well, so we have somebody who's come to us who would like a loan. They'd like us to create a note, and they're just finishing up the construction of a house. So basically, they're looking for a private money loan.
Mhm.
Now, the reason this is of note is because the way we decided to structure it. If we structure it as a full year note, it falls under CFPB guidelines, residential guidelines. So we
CFPB
have
is what, Richard?
Consumer Finance Protection Board.
Okay.
Okay. And so you have to meet all sorts of guidelines. If you make it less than 12 months, then it's a non-conforming loan, which does not have to meet that criteria, and basically is considered a commercial loan. And there are very few guidelines regarding commercial loans. It's sort of, the wild, wild west, because they figure that everybody is smart enough to know what they're doing if they're making commercial loans.
Right.
So we structure it as an 11-month loan, and we charge them 2 points up front. And in this instance, we used a 12% interest rate, which is a higher interest rate, but we have an unfinished product. So if for some reason the borrower wasn't able to finish it, we'd have to go in and build it out, which is a pain in the tail, even though we had a very good low loan to value. And so we collected our 2% fee up front. But the other thing we did, because they really weren't sure how long that they were going to have the money outstanding, was that we did what's called an interest reserve. So we took all the interest payments for the 11 months, and we took them out of the loan up front. So they don't have to be concerned about paying interest all that time. It's been paid. We know we've been paid for the term of the loan, and it makes it better for everybody, because the risk that we would run is that they would maybe have the loan for 30 days, and then we're left collecting 2 points, having done a lot of work, title, et cetera, and that's all we get out of it, as opposed to our term. So this was a little bit different in that we collected, we only made an 11-month term, and we collected all the interest up front.
Excellent. Yeah, and I hadn't heard of doing a loan that way before, so I'm glad that we had that opportunity to look at that and come up with those terms before. So it's pretty interesting, but it makes a lot of sense for both people, because that person they don't have to worry about making a payment. They don't even have to worry about coming to closing with any money, do they, Richard?
No, you basically roll all the funds, the fees and everything into the mortgage amount, and they get a net funding amount, which is handy for them.
Exactly. Yes, they didn't have to come to the table at all. They have 11 months to figure it out. And this person is liquidating other things anyway, so they will have the funds to pay for it. But it's like, if I can use somebody else's money for 11 months and not have to make any payments on it, it worked out for them.
Right.
Okay, so we're going to get into our main Q&A here in just a second. So let's finish up our last slide here, Richard. So here's our contact information. You can contact Richard at amnotecap.com. That's Richard Thornton at amnotecap.com. I'm Justin Bogart, and Justin at brightpathnotes.com. Don't forget to follow Brightpath Notes on Facebook, Twitter, and Instagram, and please subscribe to our YouTube channel as well. The next, meetup. The next broadcast that we're going to have is February 9th from 6 to 8 p.m. in 2022. And I'm not sure what the topics are for that, but we're going to hit some more storylines as well. And we're going to probably have some more case studies to talk about as well, to dive deeper. So if you guys have any questions at all about real estate note investing or about anything we've talked about today, please throw them in the comment box if you're on YouTube or Facebook. And we will be back in about 40 seconds to go over some of those questions with you.
Something else we might ask people to, if they have any topics that they would like us to cover, we'll be glad to cover them for you.
Yeah, we can even give a teaser in this Q&A if you have something that you want to just find out if that's something worth talking about. We're happy to do that. See you back in about 40 seconds.
Okay.
That was a fun one today, Richard.
I think so. I think so.
I liked mining all that data for us. I was really intrigued by the Gen Z, Gen X, millennial data. That was pretty interesting, but it wasn't, if I sat and thought about it, it wasn't that far off from what I see anyways. I do see struggles with the millennial and the Gen Z folks as far as being able to afford a home, which is great for people like us. If we're able to be that private lender for them, it kind of works out for everybody to where we can underwrite kind of like a bank, but not like a bank, and still get them into the house to set them up, get them a foundation so they can go forward and refi in the future and definitely get a more favorable interest rate for them.
That's right. The Gen Zers are going to be our renters for a while, and also the millennials. So let's see. Yeah, James has got a question here. What does he say?
Read it off. Do you gentlemen originate any seller finance notes, or do you just purchase those that are already made and paying? Great question. I'll let you answer for your part, Richard, and I'll answer after.
Well, actually, I do both. We don't originate notes like for first-time home buyers or anything like that, but we will help people restructure notes or structure notes, and make new notes and then buy them ourselves or help them sell them or whatever else.
So I get around this, and my case study today is how I kind of get around this. So it doesn't appear that I originate any of those loans, but I kind of help structure the deals. So the reason why when I run into motivated sellers and I want them to convert to a note and mortgage is because I can avoid a lot of the CFPB and Dodd-Frank requirements. Not that I'm trying to get around them, but I can avoid them because if I'm doing multiples of these every year, but somebody else is originating them, then I don't have to fall in those categories and keep documentation and do things like that, because it looks like my company isn't originating, somebody else is, and I'm just buying the note that's already originated. So I do kind of originate notes. I have done them before, but I typically am finding ways to help other people originate them, and then I'm just buying it from them from that perspective. So I'm doing a little bit of a twist to it.
Okay. So Justin, if I came to you, I was a property owner, and I said, "Hey, look, I'd like to sell this property. I'm used to getting rental income on it, but and I'd like to keep that income stream, but I really don't want all the hassles. How would you help me create a note?"
Well, it's funny you mentioned that because I'm kind of doing that right now.
Mm-hmm.
So one of my case studies is probably going to be for the next meeting, just because it'll be a fresh one in my mind, which is why I do them as they're happening. Is I have a situation like that to where somebody's wanting to get rid of the rental, maybe not exactly how you describe it. This is how it's working. So they have a rental and they need the money out of the rental because they're building a house. So I said, okay, how much do you need from your rental? And they give me a price, and I go, okay, now I need to hear about what's going on. So what do you think the property's worth? How much is the rent? What are the expenses on it? So I can get a net operating income, and I can kind of figure out what's the cash flow coming in. And I said, do you know, or have you talked with the tenant to see, would they like to just own this home? So all the answers lined up to be yes, 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 and yes. So this tenant is ecstatic because they've been renting for a long time and it's down the street from a property where they grew up at, and they would love to be the borrower on it, and they would love to buy the house. So what I end up doing is I collect the data from this tenant. I get some income information, I get some expenses information, and we kind of look at it to see, does he pass the eye test? And the ratios were very favorable for us to be the lender on it with very low risk. So there wasn't a necessity to go through like a traditional underwriting process through an RMLO. So the owner of the property still, they're the ones that are going to be on the note and mortgage, because I'm going to write the note and mortgage for them, and they're going to use it at the title company. They're going to have the borrower sign it. They're going to sign it. And then I'm going to buy the note and mortgage again at the title company at the same time, and kind of orchestrating and harvesting my own loan out of this as well. So that's kind of what I'm doing right now as a coincidence.
Mhm.
But yeah, in general, if you have a rental and somebody would like to turn them into a borrower, then we would go through a similar process and say, hey, look, let's get some data about this person. Let's find out how motivated are they. Can they bring money to closing? Because this person can. They can bring several $1,000s to closing, which is even better. So now it looks like a really traditional sale.
Right. Right.
The
Okay.
rent history is great. It shows me their propensity to pay. But if they can put more skin in the game, it's even more beneficial to us.
Right. And I asked the question because I think um, potentially a lot of our audience uh, might say, well, gee, I don't really have any money to go out and buy any notes myself. Um, I don't. Thanks, James. Um, uh, but I'd like to start to get in the note market and I'd like to be
Mm-hmm.
a player. How do I do that? And that's an excellent way for them to do that. They can go around
Yes.
in their backyard and their own communities
Yeah.
and talk to different people who own rentals and say, look, would you like to sell your property and create a note? And actually, if it's in your community, you could probably work a deal with a local realtor
Yeah.
that could help broker the deal and you could get a finder's fee, number one.
Mm-hmm.
But number two, you could help them structure the note and make some money, build up some money and buy your own notes.
I love that. That's a hustler play right there. I love that. You want to be kind of the deal maker. You know all the parts to it, and you got to figure out how to put them together. And that's a great way to make some income.
Right.
Michael wanted to get in here. Let's see.
So what is this?
That's spam. We got to kick them out.
Okay.
So future topics: finding properties to invest, and is there a checklist you follow? Your case studies are very helpful. Good. I'm glad they are, Michael. Thank you. Is there a checklist to follow? Well, there isn't one checklist to follow, unfortunately. There are a lot of engineers that get into the note space, in my opinion, and they do want to have that very methodical approach to it and checklist heavy. There can be checklists, and Richard and I both kind of have our own ways how we underwrite and look at deals and evaluate, and there are general checklists to do. But within the general checklist, bullet item, there might be sub items that are subject to change based on certain things, and everything's a little bit unique. So I don't have one that's kind of a very finite checklist, but I do have a general roadmap that I give people. And if you email me info@BrightPath Notes or email just Justin@brightpathnotes.com and tell me about you want to see the roadmap, I'll email that roadmap, Michael, or anyone else that wants it that's listening to us right now.
Right.
So thanks for the future topic as well.
Right. Let's see. I'm trying to see if no more here are popping up on my side of the screen immediately anyway, unless you've got one.
No.
Reason I brought up that other one is because I've realized that I'm not maybe I'm showing my age here, but I'm not as hip on the acronyms, that I should be and what they mean and all that. So I thought, well, maybe there's something here that I'm not understanding.
That's okay. I could tell by the name and how it was written that it was spam. So this stuff happens, unfortunately, when we're doing live things, and you just got to catch it in the moment and understand that it's not something legit. So they try to get you to click on URLs, and it takes them to somewhere else that's like a click funnel, and then maybe it's something that's damaging that they would click on, that can download to their computer. So we got to get rid of that stuff when we see it.
I see. Okay. Well, let's see. Is there anything else any other wisdom we can depart for our audience?
Well, let's give them some wisdom about vacationing in the Yucatan. What is something that you had to prepare for? Did you have to get special vaccinations to go to Yucatan?
Well, yeah, interestingly enough, I mean, Mexico is easier than any place out there. Most countries that you go to right now, you have to get vaccinated within 72 or 24 hours of your time of departure. Many places you have to get vaccinated immediately when you get off the plane.
Yeah.
Or I'm sorry, you don't get vaccinated. You have to take a test, and
test.
they will quarantine you. And one of the reasons I did not go to Thailand is because they changed their requirements, and your quarantine period was 2 weeks. And I'm not going to fly all the way to Thailand to have to sit in a hotel room for 2 weeks.
Well, yeah, I mean, it could be expensive if you were in another country too. I'm sure Thailand it's not that expensive once you get there, right?
Oh, it's very inexpensive. Matter of fact, for $100 a night, you can get a 5-star hotel. You can have,
Wow.
Get a wonderful, wonderful place in Thailand. That being said, do you want to spend that much time in a hotel room? I mean, you could do that here locally. So,
I mean, we did it for a year with COVID, right?
Yeah, exactly. But there are things like that. I think what a lot of people don't realize, like in the Yucatan, there's something down there called a cenote. Do you know what a cenote is?
No, but I have a feeling you're going to explain it to us.
I'm going to explain what it is. So my significant other is a geologist, so we get into a lot of geology talks. And most of the Yucatan is made up of very porous rock. And so you don't have rivers for the most part in the Yucatan. And you say, well, how does water get around? Well, it rains. It goes down through this porous limestone, which is the rock, and it flows underground. Well, in some cases, it gets loose, it falls away. So you have these big caverns, and then you'll get a hole that might be anywhere from 30 feet to 500 feet across.
Wow.
And they make these wonderful swimming holes and really cool places where you can go and snorkel and dive, and you're totally underground. You may be 100 feet underground.
Wow.
Yeah. And so you have to do it with headlights and all that. And it's very fun. Very fun.
That's awesome. So, Richard, I think that's all we got today. If anybody has any questions, I don't think we missed anything. I think we caught up on all the questions that we had. That was a good participation by our audience today again.
Yes. Very nice.
So I'll see you same bat time, same bat channel in February. I think it was February 9th. Is that what I had on there?
That's what you had on there? Very good.
I remember.
Your electricity held. So
yeah.
glad you didn't have any power outages, because I'd be here by myself without a script. So
yeah, I got the battery backup in the camper, so I knew, like, if something happened with the main power, the shore power, I would have some backup in here. So that was good.
So what are they doing? Are they just doing general repairs in the area, or?
Yeah, there's a substation in the small town of Lapel where the office is at, and they are doing. Duke is shutting down the power. They shut it down several times throughout the day to repair the substation, but they weren't giving updates as far as when they were going to be done. But they gave some outlandish updates, like it wasn't going to be done by like 6 o'clock, but then the power was on for a couple hours and it turned off. So I didn't want to take any chances. So that's why I said, I'll get in the camper, and we got battery backups and do all that. So
yeah, well, that works. Great. You're lucky to have a camper to do that in.
Yeah, it's the backup office.
That's right. That's right. Good.
All right. Thanks, Michael. We appreciate your participation. We appreciate everybody's participation today. Don't forget to subscribe to our YouTube channel. Check us out on Facebook, Twitter, and Instagram at Bright Path Notes. And I'm Justin Bogart with Bright Path Notes.
And Richard Thornton.
Right, this side. Richard Thornton.
That's right.
All right. We'll see y'all in February.
Okay. Take care. Bye-bye.